Hi everybody, it's Brian, and to my left I have JM Malloy, mortgage broker of Dominion Lending Centres, Canada's largest mortgage brokerage. He's been in the business over 8 years now and has serviced hundreds of different people, from people starting out to people buying their third and fourth and fifth property. Today I wanted to speak about home equity lines of credit, how they fit into people's financial lives, and why it's important to really consider this when you may not actually need to consider this, why you need to get ahead of it. Maybe we could just start in kind of mortgage and debt 101, and you could bring us up to speed on the difference between a line of credit and a home equity line of credit. What's the difference?
Sure. A line of credit is not secured, whereas a home equity line of credit is secured by your home. Because of this, you'll get much lower rates compared to an unsecured line of credit, and typically that difference is about 3%.
So much more expensive to not have it backed up.
Correct, and also you won't get as much in an unsecured line as you would with a secured line of credit.
Perfect, that makes sense. JM, the clients that we deal with during their working lives have been actively paying down the mortgage, and when they get that thing down to zero, it is time for a bottle of champagne and celebration. And it can seem counterintuitive that after paying it off all these years, you're kind of restocking your situation with like your debt profile. So bring me up to speed on why it may be important to add, hundreds of thousands of dollars of a home equity line of credit.
Yeah. Brian, you do planning with people's assets, and I feel what people are missing is planning on their debt. So there's good debt and there's bad debt. We know consumer debt is the bad debt, but good debt, a mortgage would be an example. But a line of credit would be another example of good debt, and part of that planning into retirement, because a lot of people, you start retirement in your home, and eventually as time goes on, you downsize. And a home equity line of credit gives you access to funds in your house when you need it to be able to put a deposit on, say, a new build condo or a down payment on another house before your place closes. So it gives you financial flexibility without having to sell assets and incur taxes for that.
Okay. Can you see any other circumstances where having access to $100,000, $200,000, $300,000 could be in the benefit of people?
Yeah. On the positive side, could be with gifting down payments to children. That's big in the market these days. And sort of on the negative side, if there's a health issue and there's costs incurred from that, that allows people to be able to access funds at cheaper rates than lines of credit and be able to access it quickly, so that down the line strategically they can work with you to sell their assets to pay that off instead of having to do that in a pinch.
Excellent. So why is it so important? I've heard you say this to me before. Why is it so important for people to set these facilities up before they actually take that first step into retirement? Why do they need to get it done while they're still working?
Yeah, great question, because as Canada's population is aging, I come across this more and more, and people come to me and they've had their mortgage paid off for 10 years. They're a good, 5 years to 10 years in retirement, and now they need some funds. And it's harder to qualify when you just have retirement income, whether that's a little bit of pension, CPP, and OAS. It's not equivalent to what your working salary is. So it's best to do this planning now and qualify on your working salary, because you'll be able to qualify for an amount you're looking for or more than if you're trying to do it on retirement income. And I've encountered that with retirement income, and it tends to be then they're not qualifying for these products, and I have to take them to private lending, which then is really expensive.
Got it. So the home equity line of credit is not just based on how much your house is worth. but it's how much money you make.
Correct.
So there's kind of the two variables
That's
that
right.
you need to qualify for. Okay.
Yeah.
Tell me about the application process. How does that go? Is it very laborious? Does it cost a lot of money? How does it all go?
Yeah, it's a typical mortgage application, and you do have to provide some proof of income and documentation, and then there would be some costs involved. Those are typically legal and appraisal costs, and that varies from lender to lender.
Perfect. JM, thank you so much for spending the time and giving us some insights on home equity lines of credit, why they're important to establish before you walk into retirement. If you have any questions, feel free to give me a call, or I can connect you with JM as well. Have a great day.
Thanks, Brian.